the biggest factor of the AMC MOAS, and the thing that's actually going to force shorts to cover, is rarely ever talked about. And this is going to make you guys a ton of money. So it's really a wonder why. Here in this video, we're going to talk about why the short sellers are screwed in 2022. We're also going to go over hedge fund performances because they have been absolutely terrible. No other way to put that. And we are going to touch on the Ortex data as well here in this video. So hit that like button for me. Consider subscribing to the channel. Check out the links in the description of this video, as well as the link for the buy and sell alerts in the pin comment. Now, let's jump straight into it. So, what's going to cause the short sellers to cover? Let's be real with ourselves. It comes down to putting pressure on these damn hedge funds. If they don't feel the pressure, they don't feel the need to cover on their short positions. How do you get pressure on the hedge funds? Bad hedge fund performances, which we are seeing right now, regulation, or the fundamentals of the business improving. I think it's safe to say we've seen a decent amount of regulation. Once proposed rule C10 is actually approved and we can see their short positions, that's going to be the most pressure we've seen through regulation from the hedge funds. That should come January, February, March of 2022. But on top of that, we have definitely seen the hedge funds losing a lot of money. So they're feeling the pressure on that end. If you guys are unaware, short sellers are not just forced to cover if the stock of AMC goes up. It could go to $200 or $2,000 if they have too much money because their hedge fund is performing well. Sorry to break it to you, they won't be forced to cover. But they've been losing a ton of money over the past couple of months in particular. Third and final thing, like I said, the fundamental business of AMC. And that's really what I want to hone into here in this video, because they're going to turn a profit and nobody talks about this. They want to hype you up with the short squeeze going to happen next week to $10,000 or $10 million, whatever, the titles of these videos say, but they don't talk about things that you should actually be excited about, like what we're going over here in this video. So now let's just talk about it, guys. So let's talk about the hedge fund performance first off. And they are down bad. Omicron-fueled volatility deals hedge funds' worst monthly return since March of 2020. And we can see down here that hedge funds were down an estimated 1.6 to 2% in November. The average hedge fund is up 11.4% in the first 10 months of 2021. Data from hedge fund research showed that compares to 11.8% last year and 10.5% in 2019. And what does this show you, guys? It shows you they are underperforming the S&P 500 by a very large magnitude. So on the other end of this, besides the money that they are losing in November as well as December, their lack of performance compared to the broad market is basically forcing people to withdraw their money. That's why you're seeing all these penalty programs put into place by Citadel, Jane Street Group, by all these other firms to try to keep money or clients' money for longer because they are underperforming. And why would you have your money invested in them if they're underperforming? It's pretty straightforward. So you're seeing pressure from both those two fronts as well. Robert Sears, Chief Investment Officer at London-based Capital Generation Partners, says the losses are quite widespread. A few of our managers got a little bit of positive performance, but I think in aggregate, it's going to be down. And he's talking about November as well as December. So I think it's clear hedge funds are not doing very well. If you need more proof of this, these were the 10 worst performing hedge funds in Q3 2021. The lowest hedge fund was down 28.5%. The worst hedge fund was down 38.7% just in one quarter. Pretty safe to say that hedge funds are feeling the pressure So I think it's pretty safe to say hedge funds are feeling the pressure and they are seeing their liquidity being crunched. That ultimately leads to more short positions getting covered much faster. Now let's get into the real fundamentals of AMC. Take a look at this article that was posted 1 hour ago. AMC stock, the big trend that could lift AMC Entertainment in 2022. This article goes on to say that essentially movie studios are putting their movies back into theatrical releases, which is going to drive crowds to the theaters. And that's key. And that's kind of what we already knew. But you're seeing more studios actually agreeing to do this, like Disney, Warner Brothers. A lot of other studios as well would opt to have their movies in theaters. It only makes sense. Now, if we do get into the actual financials, and this is probably the most important part of this whole video, essentially, we know that they have much more cash now. They have $1.6 billion of cash comparatively to 2018, 2019, and 2018, by the way, AMC did post a profit of $110 million. Back in 2019, they lost $149 million. We'll get into why in just a second, but their cash amounts were only about $300,000 in 2018, 2019. So we are up $1.3 billion as far as cash in the bank. But the biggest segment of really this whole video, and the most important thing to realize, is that the business of AMC, like I've said, is leaned down, is slimmed down. So essentially what that means is a lot of their bad locations, a lot of different things they were doing throughout their 100 years of business weren't necessarily all profitable. So they were forced to cut down as fast as possible to stay alive. And that's exactly what they have done. And you see this in the cost of revenue. So the best way to think about the cost of revenue is how much it takes operating your business, providing a good or service to generate this operating revenue. So if it cost AMC in 2018, when they made $110 million, $4.4 billion of their capital, their cost of revenue, to generate $5.4 billion of actual operating revenue. So after everything else is concerned, taxes, all your other liabilities are paid, they made $110 million. But these are the key numbers, the difference between these numbers right here. Now, same thing for 2019. Basically, long story short, the reason why they posted a $149 million loss is because their cost of revenue went up over $200 million. So that ate away all their profit margin. And their profit margin was not great in 2018, 2019 as well. But what do you see right here in 2021? A cost of revenue of $1.7 billion and an operating revenue of $1.3 billion. So obviously, operating revenue is still down because we were going through the pandemic in early 2021. I believe in May is when most theaters were open for business, but we had a real lack of blockbuster movies. And that's a key component of this as well. There wasn't a big reason to go to theaters besides a couple movies throughout the year. And that cost of revenue by the fourth quarter is probably going to come in at $2 billion or $2.1 billion. That's still substantially less than where we were at in 2018, 2019. But considering the full year of 2022 that we are about to see, I would estimate the cost of revenue will likely be about $3 billion. But what is AMC's estimated revenue from analysts in 2022? The average estimate is $4.61 billion. The low estimate, $4.27 billion. The high estimate, $5 billion. And I actually think it's going to be higher than $5 billion, or at least at $5 billion, because of all the movies that are coming out, the long, extensive list. We're having Avatar 2 come out. That's going to be a massive hit. Avatar, the original one, is the highest grossing movie of all time. That ran in over $3 billion of sales. Now, considering that, let's say $5 billion. Okay, go back to the financial statements. Let's say they do operating revenue of $5 billion. Well, they have a cost of revenue of $3 billion. That means they have a $2 billion difference between these numbers, the cost of revenue and the operating revenue. Now, what was it back here? What was the difference between these numbers back here in 2018, 2019? Only about $1 billion. So essentially, they're about double as efficient now than what they were in 2018 and 2019. And, you know, especially if the operating revenue does go back to $5.5 billion, closer to where it was, that's going to be $2.5 billion difference, between the cost of revenue and the operating revenue. And they're going to post a massive profit. A couple $100 million would not surprise me. And that's more in line with what I expect. In that case, the short thesis is gone. There's no fundamental case to be shorting AMC. There's no reason to short AMC. You would take your loss and move on. You would cover on your short position. And even if they don't, well, what can you do with hundreds of millions of dollars? You can issue dividends. You can continue to grow the business. You can do all these things you couldn't have done if you were not making a profit. But let me remind you again, even though they're expected, in my opinion, to make a couple $100 million at least in profit, and they're a much more efficient business, having to spend a lot less money to generate the same amount of money essentially as they did just a couple of years ago, they have $1.3 billion more cash now than they had in 2018 and 2019. So it doesn't make a lot of sense to honestly be short on AMC. Doesn't make one bit of sense at all. So I think that's ultimately what is going to cause the MOAS. Some kind of announcement, some kind of catalyst. But as the fundamentals improve, that's just reassuring the bullish case on AMC. Now, we also must acknowledge that institutional investors have been buying AMC about 10 times the speed they ever have in the month of December as the stock has been going down. That was, in my opinion, more validation that the actual value of AMC is at least $20 per share, because that is where we did bottom out at about $20 per share. So that's also good to know if you guys didn't know the logic behind that. Now finally, let's go over the Ortex data. So we're looking at, I'll refresh this page, 16.93% short interest of free float, about 86.88 million shares that are sold short, share utilization of 77.23%, and the days to cover at about 2.35, but the actual chart indicates a days to cover of about 2.4%. We are a ticking time bomb, and we are primed for a major rally. Once shorts do start to cover, days to cover is going to come down, and the price of the stock is going to go through the roof, like what happened in January and in June. So that's the fundamental case for AMC. That's really all you guys need to know as far as the fundamental case is concerned. And if you guys found value out of this video, hit that like button for me. Consider subscribing to the channel. Leave your thoughts down below in the comment section. Would love to hear from you guys. If you think fundamentals don't matter, let me know why you think fundamentals don't matter and really provide some facts to that. So that's going to be all. Love and appreciate you guys. Thank you for watching this video. I will see you in the next one.